Hello, and welcome to a public forum of the Governmental Accounting Standards Board. Great to see everybody. This is a first in a series of 3 public forums that we will have regarding our infrastructure assets project and the exposure draft that we released earlier this year. Great to have an awesome group of stakeholders with us to share their thoughts. We really appreciate all of your time. Most of you are GASAC members, but we will still introduce each other, even though we just did it yesterday, because there is at least one newcomer to the group, which we are appreciative of having Frank here. And so we'll start that in just a minute, but I just wanted to say, that yesterday, I thanked the GASAC for all your time and your investment, and you guys are just stepping it up even more and going extra mile to stay with us for extra time to provide your thoughts on this important project. And we really, really value that input and appreciate you guys staying with us and participating in the public forum. The board is very much looking forward to, and the team, to your comments and feedback. For those of you that have submitted comment letters, we have them and have read them, but look forward to being able to dialogue with you and for you to dialogue with each other about your thoughts and hear all those perspectives. And for those who haven't yet submitted a comment letter, we hope to get one, but at minimum, we'll hear your thoughts today. So thank you again for being here. With that, I guess we can do introductions, and then I'll turn it over to Joe, who will take us through the rest of the day. But I'm Joel Black. I'm the chair of the GASB, and we'll go this way.
Jeff Praviti, vice chair of the GASB.
Diane Wright, GASB member.
Bob Scott, GFOA representative to GASA.
Harriet Richardson, representing the Association of Local Government Auditors on GASAC.
Stephen Stewart, Governmental Research Association.
Frank Crawford, president of Crawford & Associates, a CPA firm based in Oklahoma City that does a lot of governmental work.
David Goldman, National League of Cities.
Robert Scott, GASB member.
Jackie Rick, GASB member.
Yamara Venkanova, GASB staff.
Joe Wickland, GASB staff.
Good morning, Carolyn Smith, GASB member.
Good morning, Linda Ragland, member of American Accounting Association.
Good morning, Rob Hamilton, the State Controller for Oregon and representing the National Association of State Auditors, Comptrollers, and Treasurers.
Good morning, Joel Levy, Nuveen Asset Management, representing the Investment Company Institute. Thank you.
Scott Deviney, I work for the Office of the Washington State Auditor, and I'm representing AGA.
Good morning, Chris Knight, GASB member.
Good morning, Alan Skelton, GASB staff.
Thanks you all. And I didn't tell you all how to work because all of you knew how to work the microphones except Frank, but he picked it up. I was watching him. He observed those before him and he got it just on pat. I had no doubts. But again, welcome. Thank you all for being here. And without further ado, I'll turn it over to Joe to start us off so that we can get into it.
All right. Good morning, everybody. And just echoing Joel's comments, thank you so much for being here. Very appreciative of all your feedback. And looking forward to hear all of your comments today. A couple of housekeeping things. Before we begin, want to note that this forum is being webcast, recorded and transcribed, primarily for analytical purposes for the staff. The recording and transcript will be a part of the GASB's public file because this is a public meeting of the board. Our objectives for this session is to hear your responses to questions about the proposals in the exposure draft. There are several ground rules intended to keep the discussion moving and to help us get through all of the questions we have in the time we have allotted today. Each of you will have an opportunity to answer each question. For each question, we'll start at a random spot and we'll go around the table, either clockwise, counterclockwise. So for clarity, I will call on one of you to by name to start that round. And then we do hope that you answer every question, but if you wish to pass on a question or to just, echo what someone has said previously, please feel free to do so. Just if you do choose to echo prior comments, please be specific about whose comments you are agreeing with, because it can be a little difficult to analyze. I agree with everything that's been said if the previous speakers might not have all been agreeing on the same thing. After everyone has had a chance to answer a question, we'll then open up to discussion. At that time, you will be able to respond to the question if you've initially passed, and you can also follow up on things that other participants have said. Just raise your nameplate, same as what we would do at a GASAC session, to let me know that you wish to say something. And then following that, I'll also then be turning it over to board members to ask follow-up questions as well. Again, please remember to turn on your microphone before you speak, and then please turn your microphone off after you speak, because that helps the camera system focus on the current speaker. And I would say before we get into it, we have expect to have a short break about halfway through. However, if you do need to step away for a minute outside of that break, please wait until after you've answered the current question before doing so. And so before we get into the questions, I guess just want to ask, are there any questions before we begin? All right. So the first topic is the definition of infrastructure assets. Paragraph 4 and 5 of the exposure draft describe the proposed definition of infrastructure assets, which would amend the current definition provided in Statement 34. The proposed definition identifies infrastructure assets as capital assets that are part of a network. They're stationary in nature. They can be maintained or preserved for a significant number of years. And the proposed guidance also includes additional clarifications of this definition by further defining networks and components of infrastructure assets. So the first question number 1, is what feedback do you have about the proposed definition of infrastructure assets? And I guess for us to start, Linda, if you would like to start us off, and then we'll go counterclockwise around the table.
Sure. Thanks, Joe. So again, Linda Ragland, American Accounting Association. So disclosure, all of my comments are going to come from our Accounting and Audit Standards Committee, and we're coming from an educational perspective and a research perspective. We are in support of the ED. We do have some comments that are mainly related to clarity. So for the definition, just three items for thought, the board. Item 1, and I'm kind of going to go down the list to make sure I get the comments correctly. So overlapping networks, from an educational perspective, how will city and state roads that are considered a network of infrastructure assets and consist of many components located within the boundaries of other states? For example, in New Hampshire, in Portsmouth, there is a bridge that's divided right down the middle. You're in New Hampshire on one half of the bridge, and then the other half of the bridge is in the state of Maine. So when we're talking about a network of infrastructure assets, how will these boundaries be identified under that network? So that's comment number 1 for clarity. Comment number 2 for clarity is dual use. So our group came up with an example. If you have dual use infrastructure assets, such as dam assets, and that have assets that provide county flood control and also provide reservoir or control for the reservoir for water supply, how do you break that up? So who will be considered either the owner? That may be clearly identified, but who's the predominant user? So who's the predominant user? Does that kind of decide how it's reported on the financials? So that predominant use piece would be very useful. And another example of predominant use is in this beautiful state of New Hampshire, they have salt sheds. These salt sheds are used about 6 months out of the year for the icy road conditions, but then the other 6 months out of the year, sometimes they put mowers in the sheds or the buildings. Sometimes they use other non-road related equipment in those buildings. So a general question is should these be part of infrastructure for the roadways, or should these just be capital assets? So from an educational perspective, just those 3 points, network. How do we define network? Again, in those tricky situations where you have a bridge that meets in the middle for 2 states. Predominant use, how do you define that? And this, I think that's it. Thank you.
Rob Hamilton, NASDAQ. Okay. So our group was in support, largely in support of the updated definition of infrastructure assets, viewing it as clear and more aligned with the nature of the assets. As we have in our comment letter, I think we're really interested in some examples, and I suspect that might come through either in some illustrations in the final standards, or if there were some implementation guidance that would assist in the effort on that front. I think as I was looking through the comments that were we had aggregated from the states, I think especially on the buildings. I know as it talks about in the exposure draft where it's integral and ancillary, and I know that's been a topic of conversation for the board as well, but just really trying to get examples of what that might look like. As we were working through our feedback, there were things ranging maybe from a terminal down to is it a pump house? And so really trying to zero in what might be those buildings, just given the spectrum of what can be attached to an infrastructure network when it is ancillary yet still integral. But again, supportive of the GASB's updated definition on this front.
Joel Levy, ICI, we're supportive of the definition.
Scott Deviney with AGA. We're generally in agreement. I do have 4 points to share. Number one, it's not clear whether the first and second sentence of paragraph 4 are presenting two different sets of criteria or one combined set of criteria for the definition of infrastructure. I think it's just the way that the paragraph's being written. And to that end, I think the standard would benefit from a glossary section. That includes definitions for infrastructure and network and component. We just noticed, some GASB standards have glossary sections and some don't. I think we're in favor of just, what's the harm? Like every section should just have a glossary, just like AICPA or FASB. And I think in this case, it would be particularly helpful because the inline text wasn't quite as clear. Number 3, I think the definition of network is still vague in that like particular type of service has to be understood colloquially. I'm not sure that everybody's going to understand, roads and bridges provide different types of service or the same type of service, right? Like if you're a vehicle, you're driving over both of them. That said, though, I don't know if it's possible to define networks better. So I think that leaves 2 potential solutions. One would just be provide lots and lots of examples to encourage consistent judgments. The other solution to consider would just be to lean into the fact that it's a judgment. Perhaps by explicitly allowing governments to define their networks by policy. And that was something that's reflected in our comment letter, just because we feel like it might allow government some flexibility in identifying their networks based on operational factors. So, for example, roads by region or by funding source, or maybe highways and roads are separate. Just due to differences in how governments plan and fund them. And then finally, speaking of examples, we love examples. Really appreciate the road example in paragraph 5. It'd be nice to get maybe one more, like a water network may consist of wells and pipes and storage facilities and pump stations. Thank you.
Bob Scott, GFOA. Agree a lot with what Scott said. Examples would be great. I really struggled with ancillary in that term and gave some examples in my letter of, would this be an ancillary or is it too big? And because it has some other uses, would it not? I think you could probably hit 70 or 80% of infrastructure assets with 5, 6, 7 examples. And I would probably try to do that to improve consistency among governments because they're going to look at it differently. For example, on my water distribution system, do I include my elevated towers? Do I include my ground storage? Do I include my pump stations? On wastewater, do I include my lift stations as part of the overall network? And if there were examples, then I think everybody would be recording those consistently. And so that was the biggest thing. I think a standard definition is really necessary. I do not think, and it'll be a question later, no doubt, components, the difference between components and networks kind of confused me a little bit. The one example for component you gave was an integral part of the roadway, the asphalt overlay. And so, but I was thinking of, well, I've got medians in my roadways. I have sidewalks in my roadways. I have stormwater drainage on my roadways. I have traffic control systems on my roadways. Are those components? Or if they have a significantly different life and depreciation cycle and its material, do I put that as a separate network? And I think there can be a lot of overlap between networks and components. And so my preference would be not to keep components at all and just encourage people towards more networks, but it's however GASB wants to do it. And that's all for my comments.
Harriet Richardson, Association of Local Government Auditors. And just up front, I want to say my comments are based on a draft of the comment letter that ALGA will be submitting. You haven't received it yet. I believe it's going to come on Friday. That's being reviewed by the ALGA board right now. So there may be a little bit of change here. But the comments so far are pretty consistent with what you've already heard. They agree with the basic definition of infrastructure assets, but they believe that the building classification remains somewhat subjective. They would like definitions of the terms integral and ancillary because they're not operationally defined. And as others have already said, examples would really be helpful. Without terms being defined, they leave room for different interpretations. And so the examples could help define what you mean by ancillary, what you mean by integral. They gave some specific types of things they would like examples of, and it was pump stations, treatment facilities, airport support buildings, traffic control structures. And they went into a little more detail on communication towers because they said need to understand the difference between what is the infrastructure part, what's related equipment, and what are technology components, and how those could be interpreted as part of a network, part of a component of an infrastructure asset. So they would like some examples and some definitions to help governments apply the definition consistently, auditors to be able to evaluate the classifications more predictably, and to prevent inconsistent capitalization decisions. Thank you.
Stephen Stewart, Governmental Research Association. We find that the proposed definition adds clarity to the concept of infrastructure assets. It allows GASB to add important new depth in the disclosure of assets by network, which is a key benefit of the exposure draft for financial statement users like our organization. Thank
you. Frank Crawford, president of Crawford & Associates. As a CPA firm that deals with either preparation or audit services for hundreds of different governments, anywhere from the size of Guam and the Virgin Islands to the town of Dewar, Oklahoma, population 200. I'm trying to bring a perspective from those types of governments. We're generally supportive of the direction of the exposure draft, and as far as this question is concerned, we agree with the limited modifications of the definition of the infrastructure assets. There are things that we like in this exposure draft, and then there are a few things that concern us. Probably the main thing that I think we need to think about is whether we can define the unit of account. I think that's going to drive everything going forward. I also, when Linda spoke earlier, it raised a question in my mind about the bridge that's owned jointly. I assume, does one state or the other have title to that bridge? Is one state have it, or is it split? Or who owns it? And then they split maintenance costs also. Okay. Yeah, those issues would have to be addressed, but again, I think there's a solution there for those also. But as far as this question is concerned, we're supportive.
David Goldman, National League of Cities. Many of the responses I'll give today are from the perspective of elected officials, being that I'm representing the National League of Cities. However, for this particular question about the definition, it's generally reasonable. Clarifying that infrastructure assets are capital assets that are part of a network, stationary and maintainable for a significant number of years, pretty much aligns with how we, view it already. We also particularly appreciate the clarification that buildings should only be considered infrastructure if their primary purpose is integral to the network. This prevents people from having to misclassify standard municipal buildings like a city hall or a public works administration building as infrastructure, and it keeps things pretty clean and understandable for our city council and the public. So,
all right, thank you. So I guess the next part of this question would then be, would anyone like to follow up on what they've heard or add to their prior comments? Okay, well, barring none, would also like to turn it over to the board. Do any of the board members wish to follow up on what they've heard in response to question number 1?
Joe, it's not a follow-up. It's an ask. Because one of the themes I just heard was examples, 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 and examples, like I've said multiple times, right? So what I would say, if there's folks in this room that have what they think in their mind are very clear examples of what networks are and what an example of a network they'd like to see other than, to your point, roads and the roads, we'd love to hear them. So like, that way we can think about what examples are the list of examples and which ones we might want to include. Because I've probably heard that word used more than any other word while we're going around the room. And if you have really good ones, we use the road and bridges example a lot, right? And so if there's other ones that are really, really redundant, the thing you said, Bob, about if we could have 5 examples, we might cover 80% of the infrastructure networks. Probably be something we might think about doing if we had an idea of what those were.
Just to play around a little bit with what Bob said earlier, maybe not for a response right now, but as the questions are being asked, one thing that I'm interested in is this idea of moving away from componentization and just looking at the network. There's a simplification to that, but then how do you balance that simplification with the whole idea of interperiod equity through appropriately valuing or looking at the asset and then depreciating that asset at the right size instead of grouping it all together. And I just want your thoughts as we kind of go through the questions on what that balance means to you, and if you think it's important or not important, or it's immaterial really when you aggregate versus disaggregate. So I'm interested in hearing you and others. I don't know.
Okay, Bob Scott.
I don't know how it works.
Yeah, no,
It's gonna be a long conversation.
I would, for networks, you talk specifically in components that they have to have a significantly different life and material ality to them. And I think you can look at networks the same way. Like, for example, in the example I gave you, do I separate out sidewalks from streets? Well, sidewalks last about half the length of streets. And so if that's material, do I separate that out? So I think you could provide some of the same criteria for a network and just drop the concept of components would be one way to approach it. But there's several different ways you can look at it.
All right, thank you. Well, I guess we will move on to the second topic, which is components. So paragraph 6 of the exposure draft proposes to separately recognize and depreciate a component of an infrastructure asset when the cost of the component is significant in relation to the total cost of the infrastructure asset, and when its estimated useful life is substantially different from that of the infrastructure asset. The board believes that the resulting amounts recognized as infrastructure assets and annual depreciation expense will be more representative of the actual use of the infrastructure assets. However, as noted in the base for conclusions, a board member has expressed an alternative view related to difficulties that the application's proposal may present for governments. And so due to considerations related to the effort that may be necessary for some governments in this regard, would also note that the componentization proposals are also not expected to be applied retroactively to the existing infrastructure assets as proposed in the exposure draft. And so that gets us to question number 2, which is, what feedback do you have about the proposal to separately recognizing and depreciating components of infrastructure assets? And I guess this time, Frank, if you would like to start us, and we'll go clockwise.
I don't count.
What?
I don't count.
Oh, no, we'll get you next time.
I think you're going to be last this time around.
Okay, that's cool. Oh, I thought you were.
As I had mentioned in our letter, I think in order to form have any form of consistency and comparability regarding the application of the statement, I think the board's going to need to identify the unit of account that needs to be determined if a component addition meets that separate classification requirements that we see in paragraph 5. As you're more than well aware, there are just a few examples included in the exposure draft that would even provide a hint of where the board's leaning is in that important area. And our concern would be that the government will compare the cost of an addition to the value of the total network, with the result being little or no componentization of infrastructure improvements being disclosed because the addition would be considered insignificant, or in other words, immaterial. So based on those examples that are there in paragraph 5 of the exposure draft, one could conclude that any addition that is a separate distinguishable part of an infrastructure asset that has a specific function in contributing to the service capacity of that infrastructure asset and is capitalized is the unit of account. And then that would also then need to be componentized. That position is based on the fact that insignificant additions, in other words, those that are below a government's capitalization threshold policy, should be reported as an expense, and the fact that the government can readily identify those components with substantially different useful lives. Based on those facts, the government can establish policies that will result in consistent and comparable disclosure of those components. If that's the case, that requirement, I think, needs to be clearly stated. So that's all for now.
Stephen Stewart, Governmental Research Association. From a general standpoint, the separate recognition of and depreciation of components would better align depreciation expense with the actual service lives of the public's infrastructure assets. This approach could improve the usefulness of the financial statements indications of how governments are consuming those assets over time. One of the possible mitigating factors there is that you do have the historical aggregated assets that are going to stay aggregated from what we can tell. Perhaps over time, as those assets are used up, you would have greater quality of information for public accountability. We think GASB could offer some implementation guidance on the terms significant cost and substantially different useful life, especially for smaller governments or those with highly aggregated records. In addition, we wanted to flag the illustration that's in Appendix C, where we have some concern that that may not be a practical solution. The example in Appendix C kind of gives 5 roads and 4 bridges as part of that, and the numbers are far greater in other cities, in most cities. And so from a user perspective, there was some concern about, as you run all of these calculations for the different components, at what point do you stop and say this is too much information and not actionable detail? So we we wanted to suggest that GASB take another look at the illustration to see if there is a way to more clearly communicate the depreciation benefits of the statement in the, maybe at the network level.
Harriet Richardson, Association of Local Government Auditors. So Aga had somewhat of a long response on this one, so I'm just going to read it and let you ask questions if you have questions. So first they said, it's not clear whether significance should be measured against the network, subsystem, individual asset, or project segment, and that existing GASB guidance allows infrastructure to be managed and depreciated by class, network, subsystem, or individual asset, but the proposed component rule does not specify which of those unit forms the denominator is the significant analysis. That omission could lead to different accounting outcomes for the same type of project depending on how a government organizes its records. The final statement should state explicitly whether the test is applied at the network level, the subsystem level, or the individual asset level. Second, the exposure draft does not address overlays, partial retirements, rehabilitation projects, or bundled projects. Many governments use composite or group depreciation methods for infrastructure and may not track individual component retirement in a way that readily supports the new requirement. The exposure draft does not explain how governments should account for partial replacements, overlays, bridge rehabilitation, or similar work that may extend useful life without replacing the entire asset. It also does not address how to remove or isolate the retired portion of a previously aggregated asset. The final statement should include practical examples and transition guidance for composite depreciation and partial retirements so that governments can implement the rule without creating inconsistent replacement and capitalization practices. Third, this term significant in relation to the total cost and substantially different estimated useful life are not defined. The final statement should provide more objective implementation guidance for determining when a component must be treated as a separate infrastructure asset. In particular, GASB should explain how governments should evaluate whether a component's cost is significant relative to the total cost of the infrastructure asset, and how different the useful life must be before it's considered substantially different. Without examples or benchmarking guidance, governments may apply the rule inconsistently, which reduces comparability and makes audit testing difficult. Guidance tailored to roads, bridges, utility systems, and similar assets would improve consistency and reduce preparer judgment risk. Thank you.
Bob Scott, GFOA. Frank pegged it, but he talks more technical than I do. So I'm just going to say it really all comes down to the level of detail. Most governments are recording their infrastructure at the 30,000 or 50,000 foot level. And I've struggled with that, but I've also struggled with finding an appropriate middle ground that isn't going to add substantial staff with, in my opinion, not a lot of extra benefit in terms of the information being acquired. We'd be tracking all this stuff, but I'm not sure we'd come up with dramatically different numbers than we would tracking at the higher level. The other thing I struggle with is my ability as a preparer to get the detail is sometimes limited. For example, developer contributions. They develop a subdivision and contribute it to the city, and it includes sidewalks. It includes the roads and the drainage and all that, but they may not break it out. I may not have that level of detail to break it out. So then am I required to try to allocate based on what I think? And, I can work with engineering, and when they do a bid, ask them to have the bid itemized so I can break that out. But a lot of the stuff we get won't be broken out because we're growing rapidly, and a lot of it right now is developer contributions. And then all the stuff that's already in place, trying to break that out And I wasn't really clear whether the standard was permitting if I set up networks. It was like you don't have to, but I wasn't sure if it was permissible to say, okay, I'm establishing separate networks for these different things. Do I break those, can I estimate what's already on the ground and break that out, or do I just start from where I am now? So I wasn't sure about that. Obviously, in my comment letter, I'm not a big fan of components. I think you're getting too detailed. And I also think that if you're not going to require disclosure in the financial statements, like for example, you required the networks to be broken out separately, great. But I didn't see that for components. So if I'm not breaking out components in my notes, and maybe I just misread it, but why would I do it? Why, tracking it and then not breaking out separately where the users could see it? I think you've got to kind of make that, is it worth adding a page to the notes versus to track all this and report it? So those are some of the issues. And then the example I gave, I think governments need to do a much better job coordinating their capitalization policies, particularly in regards to repairs and rehabilitation with their useful lives. For example, on asphalt roads, to me, if you don't do periodic mill and overlay of an asphalt road, it won't last as long. And if the assumption for the asphalt road is we're going to do mill and overlay every 8 years, and so we'll have done 3 mill and overlays by the time the 32 years of the road, and I'm just making numbers up, is gone, then it's kind of built into your depreciation. And I didn't see an asphalt overlay as any different than a roof of a building. I know that roofs are expensive, and I also know that I'm going to replace the roof on my city hall multiple times over the years. And yet I don't appreciate that separately. And I just think you could be getting into a lot of detail, but regardless of which way you go with it, they have to be coordinated with the capitalization policies, and the depreciable lives have to work together. And it also has to work with whatever the maintenance strategy that you have in place.
Scott Deviney, AGA. Yeah, our our group continues to have mixed views on componentization. There's clearly a lot of difficulties with it, and there's difficulties without it. I think in our comment letter, I was hoping to convey those mixed views, but then convey how our group was really leaning more towards the side of, I guess we're going to have componentization. It really is the root cause of a lot of practice issues that are out there that we've observed with infrastructure, and the requirement just kind of seems necessary in order for the standards to be operable and auditable, and to address the issues that we're seeing right now. So that's the group. I'll just say personally, I'm a big fan of componentization, so I'll be a guy here in the forum who's encouraging the board to keep it in, not because it's easy, but because it's necessary. I know it's possible because we've got governments that do it, and they're the ones that are doing things well. And they're the ones where we can go in and audit their capital assets and infrastructure assets, and over time, as they make decisions, those decisions are rational, and we can see how they show up in the accounting, and then the information is reliable for financial reporting. When you look at the estimated useful lives, et cetera, you get meaningful information. And we notice that and observe in the contrary, when there isn't that level of detail, I suppose, in the capital asset records, things get really messy, and then you have all the problems we see in practice where there's estimated useful lives are not necessarily reasonable, and things are fully depreciated, and I think people argue like, well, nobody cares about capital assets. Well, if clearly users do care about capital assets, and they only don't care if the information is not useful. So anyway, I'll just say really acknowledge that the requirement will certainly be costly to implement for governments that don't already do this. However, I think I'd contend that those costs are because it's messy and they need to clean it up. So I think the issue here is differences in practice between a government's asset management system compared to their capital asset listing. And I think it's differences in how they plan and execute capital projects compared to how they account for them. And it would benefit for those to be more synced up. I think governments can and do know what they're doing. They should know the condition of their assets. That should flow to operational decisions. It should flow with their maintenance plans and their capital plans, their budgets and financing should all be connected and reflected in accounting. And if it's not, then that's the problem with accounting. Okay, let's see. Yeah, it'll be difficult. Okay, if we have a requirement of componentization, just want to make two last points. I think the standard also needs a requirement that the government have a policy that defines the components for each network and defines what items are considered to be maintenance, just like Bob had very well articulated. That's absolutely necessary, and I think that's part of what the practice issues that we see is 30 years ago or 20 years ago or even 10 years ago, the government is making decisions about how to capitalize things, then there's turnover, and now they're making another decision about how to capitalize a project. And if they don't have a policy that's written down for how they're going to do things, then it's very easy for the government to make an inconsistent decision. And then when the auditor questions that, then it all can unravel. And then the last point, just agree with a lot of what Harriet said regarding the need for implementation guidance, or maybe I should say the value of implementation guidance about how to do some of that accounting and how to do the accounting not only for ongoing projects, but also at transition. That would be very helpful. Thank you.
Joel Levy, ICI. Just as a reminder to those who might be watching, I'm representing the investment side of this concept. So first, Scott, first of all, thank you. I agree with nearly everything that you said. And I just want to say that we support the idea of breaking out the infrastructure into the various components. We think that the breakout would make financial statements more actionable, and it allows investors to better assess how programs are being managed. This becomes greater importance with smaller entities. I think that's where the greatest concerns are. It also, and I'm just addressing some of the comments that have been said so far, but as it relates to network versus the individual assets, could be done categorically, but ultimately from the investment perspective, materiality is of no great surprise here, but that's ultimately what is going to be the greatest issue for us. Giving information that's not ultimately material is, of course, nice to have. Every data analyst wants, of course, data, but it's the materiality side of it that truly drives the actionable side of it from the investment side of it. And I'll just close with this. As a practical matter, it has been my experience that many entities are already creating a version of this through their back-end internal accounting systems. I know in my former role, I certainly was, and in the folks that I spoke to, in my life, they were as well. They were aggregating high-level reports, and so you saw an aggregated report, but that was a function of a lot of line-level data that sort of got there. And so just ultimately, we would be supportive of the continued breakout. Thank you.
Rob Hamilton representing NASAC. A little bit on what Chris mentioned earlier in his question. We acknowledge the board's goal of improving depreciation accuracy, interperiod equity concerns that are associated with that. However, the proposal to separately recognize and depreciate significant components of infrastructure presents serious practical, operational, and cost benefit concerns from our perspective. Across nearly every state that provided feedback and that supported our response, paragraph 6 was the most problematic requirement, with strong concerns about feasibility. States had indicated that this paragraph would require major system changes, engineering input, and new asset management processes. Department of Transportation, as they were being engaged in development of the response, reported that infrastructure is managed as single networks, not discrete components, and this would misalign misaligning the proposal with operational reality. There is strong support for the alternative view within paragraphs. I think it's B 61. I think you know which one I'm talking about, but we strongly support the alternative view on that front. I think, as was explained in the alternative view, as you're going down the path of, is this a repairs and maintenance, or is this actually a new addition to the infrastructure assets, and then looking at what am I removing from that existing infrastructure asset within the state's books, it becomes problematic, and zeroing in on what that specific item is an area of significant concern. Really support that if this were to be moving forward, having it as a perspective only is, I don't think we could go back and do a retroactive reconstruction of the records as was acknowledged within the papers, but wanted to put that, include that in this public forum as well. As was mentioned a little bit earlier by Scott, this componentization for infrastructure also introduces some conceptual inconsistency with other capital assets. I know some states do componentize, Oregon we do, but in other states that we don't, this has been talked about a little bit earlier by Bob and others. So, I'll close with this. One of the comments from the states was governments may encounter difficulties as completing newly capitalized assets components to existing recorded assets, and determining the appropriate accounting treatment for subsequent additions and replacements is particularly problematic. So I think that captures it well.
Thank you. So Linda Ragland, American Accounting Association. So from a user perspective, from an educator and a research perspective, several of us have hanging in our walls, in our offices, the conceptual framework. And there are 3 particular items that come to mind with separating out into the components: consistency, comparability, and faithful representation. Those 3 things keep bubbling up. So when the accounting audit committee met, we kept saying, okay, questions we have in terms of clarity. So in our minds, it would be very useful to provide some guidance on quantifiable thresholds deemed reasonable to trigger the componentization, right? Because if there's not consistency across governments, it's going to be very hard for users or researchers to interpret that information. In particular, what does significant and substantially different mean in terms of materiality? That's kind of echoing what Harriet said earlier. So in our minds, how do we use this information? Also, in a similar vein, how should the judgment involved in determining the significance or significant infrastructure assets and their estimates be evaluated and monitored to ensure that they're reliable and they're being faithfully represented over time? So from an educator's perspective and a research perspective, those 3 conceptual concepts keep coming back to mind. Thank you.
David Goldman, National League of Cities. So yeah, I love data. I love getting as much information as possible, but that's just me. That's not necessarily the opinion of my group. But going last, actually, let me hear everybody's opinion. And we're pretty much, the opinions I got from my group, pretty much in agreement with what most people talked about, like what Stephen said, how this would be difficult for the users to put together, and what Bob said about most governments are reporting this at the 50,000 foot level. Like Bob's example, the city hall, about most people don't depreciate the roof separately from the building, although we just put a roof on our 70-year-old police station and we are depreciating it separately, but that's because the building itself is so old. But anyway, onto the group's opinion. So the feedback I get from this group can be sometimes kind of rough. So I try to clean it up as best I can. But their opinion was basically to they're in opposition to the language and the proposal, and they agree with the alternative view expressed by the board member in the backup documents in the basis for conclusion section, mandating that cities, and there's cities that are large, very large cities that have a lot of staff, and there's cities that are extremely small, that their finance director might only be one person, and that person is also the city clerk and doing a few other things as well, and it might be a rural community with lots of roads and lots of things on their network to keep track of. So mandating that communities separate and independently depreciate components of infrastructure assets, if they have a significant cost of and a substantially different useful life, will create a pretty massive tracking regime. As the dissenting board member rightly pointed out, local governments often aggregate historical infrastructure costs by network. If our public works department does like a milling and overlay project on a segment of the road, it'll be very difficult for some towns and city staff to determine the original cost of that specific component, to remove it, or to evaluate it if the new project constitutes a significant component of the total original network. And even if this was applied prospectively, this requirement will force many users to heavily modify their capital asset tracking system and spend many hours debating capitalization versus maintenance, which would drive up administrative costs for questionable overall benefits to our board members, our city councils, and also to the users of the financial statements. If in aggregate it just turns out it's de minimis anyway. So yeah.
Thank you. So, and great feedback on that topic. I would like to turn over. Does anyone have any follow-up on what they've just heard, or anything that they would like to follow up on for the prior comments they've already made? Frank.
Yeah, I just, after listening to everybody and listening to Bob simplify what I was trying to say earlier, again, I'm going to go back to this unit of account issue. As it's written right now in paragraph 5, it seems like any addition that is a separate distinguishable part of an infrastructure asset that has a specific function in contributing to the service capacity of that infrastructure asset, and it's capitalized, is the unit of account, and then would also need to be componentized. And again, the government can set its own policies and procedures that would result in a consistent application and a comparable disclosure of those component additions. However, if that's the case, I think this requirement needs to be clearly stated. While we don't really agree with the alternative view presented in paragraphs B61 through B66, simply because estimation techniques regarding deletions could be employed, again, it would be great to have some non-authoritative examples that would assist the preparers. If the facts noted earlier in what I had just said are not supported in the broader world of practice, or the board can't agree on an appropriate unit of account, then I think I'm going to have to step back and say that we would reluctantly recommend that we remove this componentization provision and we not include it in the final statement, because without a clear unit of account, two governments could account for virtually identical road improvements in entirely different ways, and yet both could conclude that they have followed the statement. Consistency should not depend on which engineer, which accountant, or which public works director happened to be in the room when the capitalization policy was written. Moreover, if we go this route, we would recommend that the application of the composite depreciation method as established in paragraph 163 of statement 34 be specifically eliminated on a retroactive basis for similar infrastructure assets of different networks, and be specifically eliminated on a prospective basis for componentized infrastructure assets. Once more, as the board is fully aware, the composite depreciation method is not consistent with the objective of separately reporting infrastructure networks and components with related depreciation. So that's it.
Bob.
Bob Scott, GFOA, just give you an example of some of the things I've struggled with. Roads are typically put in place a mile at a time, a neighborhood at a time. They're replaced either block by block or with panel replacements where you might replace 20% of the concrete roadway in an area, and that's it, because that's technology tells you that's the only 20% that is about to fail. And so you don't want to take out good pavement and you just do it that way. And so I've struggled with that level of detail, the unit of account. And I said, well, what would it do if I recorded it block by block, since that's typically how we replace it? Well, I would go from 450 miles in a relatively small town. If I said, well, on average, there's going to be 6 or 7 blocks per mile, I would go to 4,000 or 5,000 separate units of account, and I would be tracking, and I would have to tell engineering, break this out, and then when we get the developer contribution in, we'd have to calculate. And oh, by the way, what I would have to remove would be square footage of pavement. And so, I'm thinking, well, how many people would that take to keep up with that? And would it produce any better result?
What are you doing right now, Bob, in that situation where you're replacing 20% of a road? Are you removing some factor from your current roadway structure, or you're simply putting the 20%
talks about, this is a term I've used for 30 years. Infrastructure is the Roach Motel of the general ledger. Debits check in, but they never check out. Since we don't know what value to remove, we can't really remove it. And so what we do right now, and my city is so new, we don't have a lot of panel replacements, but in my previous city, we would do major panel replacement programs, and we would capitalize the panel replacements because we had a relatively short life, depreciable life on those underlying assets that it was being removed. And I felt like my depreciation was keeping up with the pavement that was being taken out. So that was the approach we used, but it was all on a very high level. And, trying to track it on an individual level would just, the cost benefit isn't there, in my opinion.
Thank you. Scott.
Frank, were you going to respond to that?
I would just want to make sure that I understood what Bob is saying. So as you capitalize this new 20% road, you're doing absolutely nothing to the existing thing that was there. In other words, it still just is there and still remains being depreciated, effectively kind of overstating.
What my historic cost is reporting, and what I suspect almost every government's historic cost of assets is reporting, is not the assets that are still there. It's what they've spent on roadways for the last however many years. If you go to the notes, government after government, and the capital asset notes, when you look at the column retirements, it's always blank for infrastructure. Right. Nobody knows what to take out for the infrastructure, and so they don't.
But could you estimate what that number might be in order to remove that 20% that you've just replaced?
I can estimate just about anything. You asked me to get an estimate. I can give you an estimate. Whether the estimate would be accurate and reliable, that's a different issue. But
and now we have an audit issue if
right.
It's not.
No, you would have to,
because you're not componentizing.
Because keep in mind, an individual road may have 6 or 7 depreciation layers on it.
Because you're not componentizing.
You added the 4th and 5th, or the 5th and 6th lane of a 6-lane arterial. You start off with 4. Then you've done panel replacements. And so there's all these depreciation layers on a single road. And you'd have to say, well, what is the historic cost of that area of road? And you'd have to do a lot of research even before you tried to estimate.
Yeah, because you're not componentizing. So, yeah, I mean, sorry, don't mind next. Okay, sorry. Scott Devaney, AGA. I was keeping track. Yeah, I mean, I think that all of these problems are real, and the difficulties are real, but I think the counter argument is like, hey, what are we doing now, right? Like, will componentization decisions be inconsistent? Yeah, but is capital asset accounting right now and the decisions that people are making about capitalization and maintenance expense, they're already inconsistent. This is one step forward. It's not going to get us all the way to consistency. And I don't think that's realistic unless GASB is going to get to basically do capitalization policies for every government. But it's a step in the right direction. You know, how are cities doing a unit of account right now? I mean, a lot of them are they're capitalizing every new project, you know? So is this really going to create a bunch of new capital asset records? I mean, I would say not any, perhaps not more than people are doing now with all the different layers. I think the issue is they're not removing things. You know, if your existing road, let's just say a very simplistic scenario, if you have one road asset for 100 miles and you do 3 miles of replacements, to me, it doesn't have to be that hard. You don't have to break it up by every mile or block. You can just say, well, I'm going to remove 3% of my old road asset and I'm going to add on a new asset for, you know, my new project. That's one possibility. Will cities do it differently? Sure, but they're already doing it differently. So to me, you know, it sounds just a lot like cleaning out my garage. For years, I just threw boxes in there and just piled on top of each other. And I did not want to clean it out because it was going to be really difficult for me. And I'm an accountant and I don't want to put up shelves. That sounds difficult, but it's got to happen at some point or else my garage is going to be useless. And the garage is a material portion of my house and it was effectively useless except as a big storage bin. So there was one day where I'm like, I got to clean up my garage, and that's what it's going to take. I think that as the board is considering all the very valid comments about the difficulties, I think that one compromise or a way to address those difficulties would be to extend the number of years that for the effective date and to provide a lot of implementation guidance. In our experience in Washington, when governments do reach the point where you know, we have too much audit problems, too many questions, and we have to say, hey, look, you need to tear this down, and you have an accounting correction to make. In our experience, it usually takes several years for governments to kind of work through the different types of assets and work that through in their, you know, in the normal course of their business. All right, thanks.
Joel Levy, ICI. What I'm hearing, just summarizes, in many instances, this is somewhat of a black box, and that strikes me as the exact kind of thing that we'd want to try to fix. Is that because history has allowed certain things to be hard and to be masked with technology, a lot of these things can fix themselves. I'm a little bit sort of, maybe I'm misunderstanding something here, but from my issue, when my municipality was laying down roads, it could tell you exactly how long that road was good for and when they'd be back to fix it. It wasn't necessarily, so they had that information that there could be some unit of account, there could be something in place to know exactly what was going to be captured within something from an investor perspective, their ability to know how much time is left in certain municipalities. I don't know of any investor who wants to know that Joel Street got a patch. I don't think that's valuable from the materiality perspective. And that's just why I want to sort of bring that up is I do think materiality matters. And so I think that if that was an overlay or continues to be an overlay, that would change some of the issues here. But I do think that if I'm an investor and I want to be able to know what is happening from the infrastructure within a municipality, this is one way for me to look at the financials and know what might be coming down the road. Because as we all know, there are many entities who delay updating these things for, we'll just assume, very good reasons. But the only way to really capture that, to see how that is growing in a meaningful way year after year, is to have that component break out for the material side of it.
Dave Goldman, National League of Cities. I mean, maybe we could think of this as just to make things a little bit more manageable for governments. Maybe we can think of this like how we handle leases and SPIDAs. You come up with a threshold, and then you really drill down and look at the assets that are at that threshold, like a materiality threshold or capitalization threshold, and things that are below that, like the patches or the little things. Even even if we are capitalizing them because they're over like our capitalization threshold, maybe there's a higher threshold when it comes to this, so that it's a little bit easier on cities. And maybe, I mean, I don't know if you want to differentiate cities that have over 50,000 population than the ones that have under 50,000 population. That might make things complicated, but cities that are larger tend to have more capacity to do more, have more staff, have more resources. So that might be something to think about too. And going on Scott's mental model of the cleaning up the garage, sometimes you have to do it. It's just a mess and you need to organize it so you can actually utilize it. Reminded me of when I first got into budgeting. I jumped into something called zero-based budgeting, which was like this intense looking at every invoice, looking at everything that came into the city to build every department up from scratch. And it took copious amounts of time, weekends, working 14-hour days, putting down revolts from my staff, all that. And at the end of the process, the budget ended up being barely different than if we just did it the normal way. So, just something to think about.
Rob. So as I was listening to some of the comments, and I appreciate where David's final comment was, like all the time and effort, and you kind of ended up in a similar spot, with, at least it was illustrative in terms of letting you know that you were getting into a similar spot, and the avenues were going to get you a similar answer. But as I was kind of listening to the feedback and Scott's comments on the componentization and whatnot, and then looking at the feedback that we got from some states, for the record, I know that our state, at least, and I'm sure that most other states, we do remove our infrastructure assets. And I know that just as an example, but we have those that are coming off. And, for us, when we're looking at infrastructure, are we extending the life? Or are we just putting work into to meet our expected useful life as we were originally anticipated? So I think we're seeing less that's going in and not coming out, or we're just expensing those, which gets us back to the interperiod equity concerns that I know have been addressed multiple times in the duration of this project. But from a state perspective, one state quoted us as saying they have 80,000 miles of roadway, 13,800 bridges, 4,900 culverts and pipes. So the expanse of some of these is dramatic. And on top of that, states are in different geographic and topographical regions, whether it's the coast or the mountains. And so the considerations that go into maintenance for one part of the state may look different than another part of the state. And so I think that adds to the complexity of the componentization, where these states really are doing these at a macro level, at a network level. And so underscoring some of the challenges of trying to implement something at this componentization level, as well-founded as it might be and understandable in terms of the interperiod equity concerns, I think where we get into at the end, it might be very similar to Dave's experience, where it's not dramatically different for the time and effort that would go into it.
And Bob, and I would just say too, because we have quite a bit to still get through today. So after Bob, I'll be turning it over to the board as well.
Infrastructure is not a black box. They know the problem is those systems don't talk to each other. And so we have to set up something from a cost benefit perspective in our general ledger and in our accounting systems. But they have 5-year capital plans, they have 10-year capital plans. And so all that's good. Also, when I set up in my previous city, GASB 34, the plan was to remove the infrastructure once it became fully depreciated. So my plan was to get the old assets off the books once they became fully depreciated, but not necessarily when they were replaced by a capital project.
So you remove the capital assets from your records just when they got fully depreciated, whether they were still in operation or not.
Right.
Not in Washington.
All right. Thank you, everybody. Before we move off for this topic, want to make sure I give time to the board. Does the board have any follow-up comments they have or questions they want to follow up on for what they just heard? Diane.
Thank you. Joel, I'm really interested in the materiality piece. You've mentioned it a couple times. And so depreciation is just a fraction of the cost. And you're breaking out a fraction of the fraction when you're doing componentization. What do you, from a materiality standpoint, what do you think you're going to get from componentization? And how long is it going to take to build that up if we do this prospectively to actually have any kind of impact?
Well, I'm not sure how long it's going to take. I would have to leave that to you folks to tell me how long that would side of it. I'm just thinking about it from a perspective, the depreciation, this is why I keep talking about the materiality side of it, is I know that we're replacing a lot of small roads and things like that. So that's just kind of known. But for me, in my mind, is that I'm most worried about, or from the investor perspective, I'm worried about people who significantly delay the refresh of things for various reasons. And that's not necessarily captured. You can't see specifically what's being delayed, and the importance of what's being delayed always. And so there's sort of that side of it. And the smaller entities who, when they do have to make a large capital improvement that has been delayed for various reasons, how that will have a material impact upon their financials potentially either coming to market, how the rating agencies might view it. I know the rating agencies in the past have highlighted, I don't want to speak on behalf of my rating agency brethren, but in the past, they've certainly highlighted how those delays have caused issues. So depreciation is one way for us to see what kind of delays are taking place within their capital plan. And so I'm trying to just get a sense of knowing for those smaller entities what might be coming down the road that you would think would be in the capital improvement plan, but have been delayed for various and sundry reasons. And unfortunately, the way life tends to work is you have to make that change, you have to make that improvement at the worst possible time. Either access to market could be poor, interest rates could be high, the economy could be in the wrong position. So from an investment perspective, just trying to get a more holistic view of where the assets actually sit.
So if I could just follow up, so how do you see the componentization playing into the delay? I know we're trying to get at that, like that 80% and 100%. And so there's different things that we're building into this. How do you see the componentization playing into that?
Well, broken out specifically within roads, I think are a little bit, hard, but just not quite the same. But in sort of my head, I'm thinking about a water treatment plant. And a water treatment plant has various components that are substantially more expensive than others and have different useful life than others. And so if a particular component hasn't been replaced for a long time, but would represent a substantial cost to it, I would want to know that. I would want to know that in water treatment plant that they're going to have to, or in, again, I know it's different, but a municipal power generation, where we'll just say oil, where let's say burning oil, where that component hasn't been replaced for a period of time, and it's been sort of delayed because it's expensive and sort of whatnot. I would like to know the breakouts of those kind of assets. Just categorically, just in the back of my mind, how those would fit in.
Okay, so one more question. So you won't get to that on the financial statements or the disclosures because there's nothing that says you have to disclose components. You'll see it by network.
Right.
So even if they're componentizing and depreciating it differently, you're going to see water system treatment plant and then the total depreciation. So again, how does the componentization, is that because you can call them up and they will have the information? Is that what you're looking for? Because I don't see that you're going to get it on the financial report.
And certainly the analyst will do just that. They will call them on the phone and ask that very sort of question: why are we seeing this? What is happening? Can we have a different kind of breakout? And to the extent that they can share that, because it may be a non-material, it may be a material issue, in which case we always encourage people to make that public. But ultimately, it does lead to further questions.
Joe.
So I had some questions, but Frank and Bob and Scott in their follow-ups kind of brought out what I was going to ask about. So I think I'm probably going to make a little bit more of a comment than ask a question, especially in the interest of time. To me, there's two kind of benefits that we were trying to achieve with this componentization. One is improved depreciation expense, right? It's a real number. I think this is also what Joel has been getting at. It's a real number that they use in their analysis. And if it isn't an accurate depiction or as the best depiction we can get at, then it's not as meaningful as it could be. And I think componentization would improve that. But the second part is maybe the part that concerns me even more. It is this kind of double counting. Is this the Roach Motel, right? I was going to ask you about the Roach Motel, and then you brought it up because our research shows, my experience shows what you describe, except that there was no plan to ever take the old things off. They're just going to be there forever. And we just build on top of them and on top of them. And we're double and sometimes triple counting some of these assets. And in spite of there being implementation guidance currently, especially as it relates to the composite method, that you're supposed to estimate and break those things out. And Frank points out that you can estimate that. Our experiences in governments don't do that. And so if there's a different way to shine a light on that and get that accounting kind of the way it should be now, so that we at least take those things out if we're going to add them on, or if we don't add them on, we expense them, right? Which is then gets at your blips and our expenses and interperiod equity is, that's one of the componentization would smooth that out. I'm open to other kind of ideas of how to kind of mitigate that concern. And then you're just down to now it's the cost benefit of this. Is depreciation expense better or could it be better or worse? That's just my comment.
And I don't know if this helps Joel at all, but I mean, back when GASB 34 came out and, the idea was get any kind of number for roadway infrastructure and get it on the books. Use whatever estimation techniques you can. So people literally got in their car and drove lane miles of roads and watched the odometer tick up until they figured out, I got 87 lane miles of roads. Well, they're about halfway depreciated. They got a 50-year life. So I'm going to put them on the books at 50% depreciated. There's my two numbers, cost and 50% depreciation. The next 25 years, 1/25 of that ticks off into depreciation expense. But then every year, they'll make roadway improvements on that very system, on those 87 miles of roads, and they'll capitalize roadway improvements in 2001, roadway improvements in 2002. So all the while that an old roadway addition, the group number, the composite number gets depreciated off, there's a new layer being on, so that 25 years later, that entire road network is gone, but it has been replaced now with a new road network in 25 layers in theory. And so I'm not so sure componentizing all of this without defining that unit of account is going to provide us that much more data than what we already have. But again, we're in the same situation that Bob's in, where if we're not taking things out, chances are, unless Bob has really accelerated his depreciation, he's over capitalizing, over counting, overstating his infrastructure assets. But that's not the way everybody does it. It's different everywhere, and that's the problem.
And I agree, Frank, right? And this gets a little bit, Scott, is this a perfect solution? No, there are other solutions we could have come to that might be better ways to account for infrastructure. We're just trying to make kind of improvements upon and from the GASB 34, which was, let's just get it all on. We're trying to make an incremental improvement. And so we're just going to have to work to find the right balance of making that as much of an improvement, but minimizing cost.
And I think that's why when we did that in 34 and we said, just get something on the books and get it there, people did the minimum amount to get something on the books. So they didn't go into a level of detail that perhaps they should have or could have in order to get that. So now to have them come back 25 years later, 26 years later and say, oh, by the way, we want you to do it differently now is and expect those records to be there to where we can go back and kind of figure this out.
That can be how you implement prospective.
Correct.
Could also be another way to get at that. And that might take us longer to get to all the benefit, but maybe it still would be incremental. So that's another option the board can consider.
Jeff.
Just quickly, because I understand we're interested in time, but just getting at the back and forth between Diane and Joel. I just want to be clear as someone, Joel, who worked at a rating agency, so I have this, what you're talking about. I just think it should be clear that the value of this componentization information isn't simply about disclosure of it. It's about what Joel is talking about. It's about the depreciation expense. If you have a significant component to a water treatment plant that's got a 50-year useful life, and that significant component has 10 years, that thing now has just been masked for depreciation purposes. It'll be depreciated over 50, not depreciated over 10. And all the other stuff that we're going to do, and rating agencies do a lot of age of plant calculations, right? Because they're trying to figure out what's the future debt problem going to be in this government. And that's going to be as a result of their assets that have been worn down. And if that calculation is masking what could be significant differences, that's going to change and they're changing ratings based on those decisions. Those are big decisions for a lot of governments, right? And so if that information is less accurate, that's a problem. And it's not about disclosure. It's about how that depreciation gets done and what those raw numbers are, because they're taking those raw numbers and calculating what that future need is. And if it's obscured because it's part of a component that's part of a bigger thing with a longer life, that will lead to less accurate information.
I'd say
at some point we got.
Yeah, for the sake of time. All right, so because we're going to move on to the third question, and I think for the sake of time too, we're going to talk about question 3 and 4 kind of together. They kind of touch on the same topic, just so we can address that one. And so,
Joe, how many questions do you have so that we can kind of moderate? There's 10, there's 9. Okay, so you've got 9. So
8 questions. We've gone through
Okay.
the first 2. And I anticipated might want to talk a bit about component, but
That was one of the big ones that Bob.
that was, yeah. So let's talk about periodic reviews, which will end up being, we'll answer kind of 2 questions in one. We'll address both the proposed guidance as well as the transition guidance for that. So paragraph 7 of the exposure draft proposes to emphasize existing implementation guidance for performing periodic reviews for estimated useful lives, salvage values, using the measurement of depreciation expense for all capital assets, but doing it specifically for infrastructure assets that are being depreciated. The board's intent is in part due to the significant number of years over which infrastructure assets are used to provide service and concerns expressed by users during the pre-agenda research indicating that a significant number of governments have infrastructure assets that are currently reported as fully depreciated, even though those assets are still being used by governments to provide services. Additionally, paragraph 17B of the exposure draft has proposed transition guidance that would require such review to be performed at implementation And paragraph 15 also proposes that changes resulting from that review and implementation be reported retroactively by restating beginning net position or fund net position as applicable for the change from prior periods. And so originally we had two questions here. I'll read both, but we'll just kind of broadly be talking about periodic reviews. And the first is question 3, which is what feedback do you have about the proposal to perform periodic reviews of the estimated useful lives and salvage values of infrastructure assets? And additionally, question 4 was what feedback do you have about that proposal to perform that review as a part of implementation and to restate beginning net position or fund net position for the cumulative effect of that change on prior periods? And David, let's start with you this time, and we'll go counterclockwise.
3.
Yeah, thank you. Periodic reviews.
All right. Dave Goldman, National League of Cities. So I'll just get, since a timing issue, we'll just get right into I'll stay on script. So in theory, ensuring our estimates are accurate is a sound practice to avoid reporting fully depreciated assets that are still in use. However, the board should ensure that the term periodic remains flexible. Cities don't always have the capacity and wherewithal to hire expensive external engineering firms every few years, or using copious amounts of internal staff just to reevaluate the useful life of every sidewalk, pipe, street lamp, bus bench in the city. So as long as this requirement relies on management's professional judgment and aligns with our existing practical capital planning cycles, that's supportable. And for 4, so the group strongly disagreed with the requirement to restate beginning net position. While performing a baseline review at implementation makes sense, forcing local governments to calculate the retroactive cumulative effect of all these estimate changes for prior periods could really result in an incredibly time-consuming, backwards-looking exercise. Reopening prior calculations for asset networks is exactly the kind of costly accounting exercise elected officials hate, although I love, as it provides a minimal forward-looking value for current budgetary decisions. So the thought was, if there's any changes in accounting estimates, they should be applied prospectively.
Thank you. I should be pretty quick on this. Again, from a user perspective, for timeliness and consistency, more guidance in terms of what's periodic review mean? 6 months, year, every 2 years? Again, for those of us that compare and contrast financials, just having some sort of consistency in the guidance would be extremely helpful. And again, from a user perspective, restating in our minds makes the most sense. Therefore, we can see what the results were as of time 0 when this implementation goes into effect. Thank you.
Rob Hamilton from NASAC. In our the states that helped to inform our letter indicated that requiring periodic reviews is appropriate and could help correct longstanding issues such as assets remaining in service long after being fully depreciated. That said, the term periodic is viewed as being too vague, and many states have urged that a time frame be specified. I know that in paragraph B19 it was addressed and decided against, but our group asked for a reconsideration of that, looking for is there a suggested time frame, whether that's 3 to 5 years or even an outer bounds, maybe going up as far as to say every at least 10 years a periodic review should be established. And then in terms of going back and what the implementation date is, I think there was less coalescence around an official position there. I think acknowledging that there would be a substantial amount of work, but again, knowing that there's value in conducting this review.
Joel Levy, ICI. We support the idea of a periodic review. Echoing other comments, if a periodic review, a hard date is not something that we feel that or you feel that you can do, then we would recommend a not to exceed date. So you have with the understanding that those often get translated into that is when they will actually do it. So there might be a threshold of population to consider that, but certainly a not to exceed date, I think, would provide a floor. Thank you.
Scott Davini, AGA. Yeah, we agree. with moving this to category A gap. I think our main comment is just strongly believe that periodic should be defined consistent with GASB literature for other types of estimates. Without repeating what everyone else has said, I would say alternatively, if the board does not wish to define it, and I think we definitely, our group respects the idea that maybe the GASB wants to provide flexibility for these long-lived assets, then could you please put into the standard a requirement that the government define that by policy? It doesn't have to be disclosed. It just needs to be defined by policy. I think that the basic logic is, to get periodic reviews, there has to be a consistent and systematic method. Otherwise, it's not periodic, it's ad hoc or erratic or not done. And to have a consistent method, it has to be defined either by standards, or if not by standards, then by policy. If neither, it's not going to be effective. And I think that, I just urge the board to look at the evidence of current practice. If it's I just don't believe it's going to be effective to leave that logic unsaid. So I totally understand that you're like, well, you'd have to have a policy in order to do that yourself. But the fact is that governments don't right now. And that's what makes it not auditable right now. So, we go to the nth degree on estimate methodology for other things like AROs or SPEDA, which are like 99% immaterial. This is one of the most material items on the financial statement. So I think that it's worth having that requirement. Oh, and then for question 4, strongly support, restatement's I think a very practical solution to just get everyone on the same page. I think that it's a real positive. If governments have already been following the category B guidance, it should be no big deal. If governments have not been, then you should be happy and grateful that you get to report this as a change in accounting principle instead of an accounting correction. Thank you. Yes, an accounting error.
Bob Scott, GFOA. As I read paragraph 7, I don't see that the periodic review is mandatory to implementation. And I think if GASB wants to increase comparability, that the first review should be when they implement the standard. And I would make that the only time you would allow for the retroactive restatement, again, to lend to comparability and to also try to avoid, my net position's getting kind of low. Let me do a periodic review of my assets and bump it up. You don't want that. You want a one-time look. And then after that, and I think even giving some indicators for government when a periodic review may be necessary, like changes in technology. We started using in situ form to line our water mains rather than replacing the water mains, or things of that nature, changes in technology, but no less than 5 years, 10 years for the periodic review, I think would be a common sense approach to look at the review. I don't like in 7 where you say including salvage values, because the vast majority of the time infrastructure has no salvage value. You pound the pavement into rubble and you haul the rubble off. You abandon the water line in place. There is no residual value, and it makes it sound a lot like other capital assets. And infrastructure is different. So if I was to add anything, any extra to it would be including looking at your capitalization policy for repairs and rehabilitation, rather than talking about considering salvage value.
Harriet Richardson, Association of Local Government Auditors. So as others have said, the term periodic review needs some clarification. It's too vague. Alga thinks that it's directionally appropriate, but wants some clarity about what that means in terms of expectations for review policies, documentation of assumptions, and that sort of thing. Regarding salvage value, again, as Bob just said, they feel like it's not a worthwhile effort to calculate salvage values because often there is no salvage value or the salvage value is immaterial. And so it creates a potential for unnecessary analysis without a corresponding benefit. So thinking about clarifying that salvage value should only be required to be reported when it's been used in the depreciation calculation or when the facts and circumstances indicate that it may be material. Regarding question 4, I want to go back a little bit to what Frank said earlier about GASB 34, that the legacy infrastructure records may not support the disclosure without a significant level of effort because the records were not, when GASB 34 was implemented, the records weren't maintained in such a manner to create, for them to be able to create the records now. And maybe they should have been, but in many cases they weren't. So they think that coming up with some sort of a transitional approach for how to do that, maybe prospectively would be a better way than saying go back to all the old stuff and try and reconfigure it to fit what you want it to be now. And then again, thinking about retroactive restatement of estimates, thinking about, again, whether or not that's beneficial or maybe a prospective method would be better for, especially because governments don't have the resources to go back. Many governments don't have the resources to go back and recreate things. And so thinking about should it be a prospective approach rather than going back and recreating things from the past. So thank you.
Stephen Stewart, Governmental Research Association. We support the idea of periodic review. GASB could offer some additional or some implementation guidance on how often governments should review useful lives and salvage values going forward. So I agree with a number of what people have said already about trying to give governments some guidance on what does that period look like. This could support consistency in reporting over time. And we also are in support of question 4, just the periodic review and adjustment at implementation would help with consistent implementation of the standard.
Frank Crawford again. Sorry. On question 3, I think it's universal. I think the proposed requirement to periodically review the estimated useful lives and salvage values is sound. While that guidance currently resides in level B gap, as Scott and a couple of others have mentioned, I think moving it to level A gap will raise the awareness of how important that guidance actually is. However, despite the current guidance, governments frequently use assumptions established years or even decades earlier right now. A periodic review would then prevent those assumptions from fossilizing into the equivalent of a financial statement accounting amber. Good estimates should evolve as the government learns more about their capital assets and not remain unchanged simply because they appeared in a depreciation schedule when the Clinton administration was in office. So one issue about salvage value I want to mention, as several others have mentioned, most of the time infrastructure salvage values are 0. And if they could be less than 0 and a negative number, that would actually be more appropriate. My governments will use an asset to the point that you have to pay someone else to come to your lot to get it off of your property. So there is no accounting for that. But salvage value, I believe, is kind of a minimal issue as far as infrastructure is concerned. On the 4th question is probably where I struggle the most. And don't get me wrong, there are probably 10 people on the planet that you do not want to get into a debate with about governmental GAAP and governmental accounting. There are 8-ish of those people in this room today. Me, I'm like 13th, so you got nothing to worry about. I'm trying to get into the top 10, but I'm not there yet. So I struggle with the concept of why we have assets that are 100% depreciated on the books that are still in operation. To me, that is an error. That is a mistake. It's a mistake caused by one of two things. We failed to assign the correct useful life at the very beginning and then failed to monitor it periodically in order to adjust it, or we failed to capitalize significant repair and maintenance expense that extended the original life beyond what we had originally estimated. Both of those are errors to me. I would think that maybe we ought to just acknowledge that, yep, those are errors and call this what it is based on what we see in paragraph or in GASB 100 in paragraph 12. This is an error. Right now, we kind of seem to have a get out of jail free card where we can just go adjust accumulated depreciation, call it a change in accounting principle and move on. But that's not really what this is. This is a mistake. And I think as much as I don't want to report an error, I also don't want to disclose a large portion of infrastructure assets as either fully depreciated or nearly fully depreciated. To me, in my mind, there should not be an asset that has 100% depreciation, especially infrastructure. If it got there, it's because I made an error. And so the disclosure related to assets over 100% depreciated, if I do my work correctly, there isn't going to be a disclosure related to that because none of them will be. If they are still in service, if they are still in operation, that's just an error, that's just a mistake, and I need to fix it. And so the 80% rule, no problem at all with it. I think we're in good shape there. I would recommend that in paragraph B49 in the final statement, we clearly state the reasons why the board believes that any change to the estimated useful lives of infrastructure assets as a result of that review should be presented at the beginning of the period of implementation as a restatement of beginning net position or as fund net position as applicable. In other words, that it is an error. Moreover, given that the transition or at the restatement guidance is presented as part of the transition guidance in paragraph 18, and it is not codified, it seems clear to us that this restatement guidance is intended to only be applied when this statement is implemented. However, that nuance may not be clear to other stakeholders. Therefore, we would recommend that paragraph B49 in the final statement clearly state that fact, and that a question and answer addressing this issue be included in the first implementation guide that includes the statement within its scope, because without that guidance, our concern is that governments, when faced with disclosing depreciated infrastructure assets based on paragraph 11, will attempt to apply the provisions of paragraph 18 well after the implementation of this statement. And so that's kind of where we are on that question number 4.
All right, thank you. I guess we'll turn it over to do any of the participants would you like to follow up on any of the comments you've just heard or your prior comments? And Bob, saw you first.
Okay, Bob Scott. And clarification, my comment letter was from my town and from me personally, not for GFOA. I think GFOA is going to do a separate response letter. So even though I am GFOA's representative on Gas Act, this is my personal views. I am not particularly concerned if I have a fully depreciated asset on my books because I view the depreciation period as an average. I know that some of my assets will be replaced prior to the end of the depreciation period. I also know that some will remain in place. And what I'm seeing on my concrete streets is they'll be replaced in pieces. And so if I end my depreciation period and half of the original pavement is in place and the other half has been replaced, then on average, my depreciation expense is fine. And that's kind of how I looked at it because I don't know how to remove it. And so if you don't remove the stuff when it's replaced prior to the end of the depreciation period, then you probably shouldn't be overly concerned if you have some that's fully depreciated, because as long as it's not out of proportion. My experience is that it's out of proportion right now, which is why I supported paragraph 7.
Did you, Bob, did you mention that? I thought you had mentioned earlier that when your assets get fully depreciated, you pull them off.
When they are fully depreciated, they get pulled off. So yes, there would be some fully depreciated assets that would no longer be in the records, but there would also be a significant amount of assets that no longer exist, that have been replaced, that aren't at the end of the depreciation period yet.
So you would have no 100% depreciated assets based on what you've described.
Right.
That you would be disclosing.
Right.
Only the 80%.
Right.
Okay.
And yeah, only the 80%.
So nothing 100%.
Right.
Linda.
Thank you. I abbreviated my response earlier for purposes of brevity, but I heard a couple things about lack of salvage value. So I wanted to bring up one thought. So that in my group, we talked about while most capital assets in terms of infrastructure don't have salvage value, some of them do. And the example that we kept coming back to was the dam again. When we think about a dam, the concrete itself is probably not going to have much salvage value. But folks with knowledge suggest that those turbines in those dams have significant secondary market value, and it's very volatile. So for those that's trying to capture the information about the salvage value, it's going to introduce some uncertainty and some noise in those estimates, market conditions, inflation factors, etc. So there are some capital assets in the infrastructure vein that do have significant value, and in consideration of how do we deal with those. And if you're looking at a small municipality that has a county dam, it's going to introduce a lot of volatility coming up with those salvage values. And on top of that, consideration for the auditors. Will those estimates withstand audit scrutiny? Just food for thought. Thank you.
Scott.
Yeah, I don't know. Dams are an ARO, at least where I come from. I just want to say that I mostly concur with Frank's comments. There's a few instances, scenarios where there can be, it's valid, fully depreciated assets, but I think that by and large, what we're seeing is just governments are not, it's an error. Where I diverge from Frank's comments is our group very much appreciates the get out of jail free card and is strongly in support of that. So thank you. Thank you.
Frank.
Just lastly, somebody correct me if I'm wrong. Is there a theoretical basis in GAAP as it stands right now for having an asset on the books that is still in operation yet is charging no expense to the current period? Is there any theoretical basis for that in GAAP? Because if there is, I don't know where it's at.
No.
Okay, that's all I need.
All right. Before we move on for this, I also want to make sure, do any of the board members wish to follow up on what they've heard regarding the feedback about periodic reviews?
I don't have anything, but I want to say that I think I just moved up to number 12.
Yes, we'll do a 5-minute break real quick, just for the sake of time. Refresh, we'll come back, then we'll reset for the remaining questions we have. All right, everybody. Got about an hour left to go. Do I have Rob? Jackie? All right. All right. Thank you, everyone. So far, great feedback. Sincerely appreciated. This has been very useful. As you can imagine, lots of fun stuff still to talk about. We've got 1 hour left in the session. Let's talk with Alan. We're going to change up some of the order of questions to make sure we're getting just ones that had a little bit more feedback either we saw in comment letters from participants and other items, to really make sure that the things where there's a lot of feedback, we're kind of talking about those up front. But so we've got 4 questions for the last hour. We'll see if we can get all the way through them. But just so you're aware, the order that we're going to be going is we're going to be talking about the disclosure of infrastructure assets that have exceeded 80% of their estimated useful lives, then maintenance and preservation expense, then disclosures by network, and then if time, disclosures of policies. So we're going to approach the remaining hour there. And so the first question that I'm going to tee up is, this is question 6 in your materials, which is infrastructure assets exceeding 80% of their estimated useful lives. So paragraph 11 of the exposure draft proposes to disclose the historical cost, the accumulated depreciation, and the historical cost weighted average age of infrastructure assets reported using historical cost and accumulated depreciation that have exceeded 80% of their estimated useful lives. That information would then be separated between those assets that are fully depreciated and those that are not. Additionally, this information will be provided by network of infrastructure assets. And so question 6 is, what feedback do you have about the proposal to disclose information about infrastructure assets reporting using historical cost net of accumulated depreciation that have exceeded 80% of their estimated useful lives? And this time, Harriet, if you could start us off, and then we'll go clockwise.
Sure. Harriet Richardson, Association of Local Government Auditors. So ALGA said that they thought the 80% threshold would be easy to apply, but because different asset classes have different deterioration patterns, it may not be a reliable estimate for whether infrastructure is nearing the end of its useful service life. Assets with long useful lives, highly variable maintenance patterns, or materially different condition characteristics may not fit the threshold well. GASB should either better justify the threshold or allow governments to supplement the age-based disclosure with condition-based information so users can distinguish assets that are approaching end of life from those that are simply old. Thank you.
Okay, Bob Scott. Again, I do not, in my letter I stated, I do not think that disclosing an individual or groups of 30 and 40-year-old depreciation layers is particularly useful, since most governments, one, don't know what is in that depreciation layer. They don't know what the capital project finaled in that year were. They don't know what the developer contributions were. And 2, they don't know how much of that layer is still in existence. Half the pavement may have already been replaced. So it's nearing it because of its age. When I come up with an average depreciable life, I assume that things are going to be replaced as it approaches the end of that life. And I see it happening. And so I don't think it's a incredibly useful disclosure, because I know what you're trying to get at, but I don't think it really tells you that. And so for me, I would oppose the disclosure. It'll probably be more meaningful once we do the reset, because I think I did over depreciate. I used engineering design life for my roads. Sounded like a very verifiable, logical thing to do. Well, what I figured out later was, engineering design life at 30 years just means that for the first 30 years, you're good to go and it's going to have very little maintenance. It doesn't mean it's going to last 30 years. It means that after 30 years, you're going to be doing substantial replacement and repairs. And so I admittedly over depreciated, and I actually adjusted about 10, 15 years into GASB 34. I was looking at the numbers and I was like, what I did is not turning out to be reality, so I need to fix it. But of course, the only way I could fix it was prospectively. And so my layers were already, many of them were nearing complete depreciation already. So when you change it prospectively, you just don't see the impact. It's a subtle change, but not really anything I'm sure most users would have noticed. And that's why I'm supporting the retroactive, because I think this gives governments an opportunity for a one-time, I think it should be a one-time reset of the number.
Scott Deviney, AGA. Yeah, we agree with the new disclosure. The idea that we're identifying the amount of assets that is near the end of its useful life and the amount of assets that is at or over its estimated useful life. I think it should relate directly to the government's capital planning and budgeting. It should be a measure of near-term capital needs. To react to previous comments, if the capitalization depreciation is being done right, it's a good measure and provides useful information. If it's not a good measure or not providing useful information, then to me, it means that the capitalization and depreciation aren't being done right. We did have 3 suggestions for improvement of the proposed disclosure. One, our group of experienced CPAs just disagrees with the idea of including this weighted average age of assets within each category. We just really struggled to understand what decision useful information that was providing, and it's certainly very complicated. So yeah, we disagreed with that. Secondly, and this was not a strong suggestion, just a lot of discussion about is 80% the right threshold, and maybe something closer to 90%. But I think we would mainly defer to users on that. Our concern was just that it might represent too long of a category, and again, if it represents assets that are not going to be replaced for another 10, 15 years, then is that kind of too much to be actionable, and you don't want it to be ignored. I think the value again is the indicator of assets that need to be replaced in the near term and should be, something that's on the government's capital plan and budgets. And then 3, this is a small one, but the group was unanimous in that really appreciate the inclusion of that example, but strongly prefer that the disclosure example be in the form of a table with maybe multiple network showed. So following the example of roads and bridges in Appendix C, and if the illustration was intended to indicate the bridges were at 0, then it would be really helpful if it was again in that table and showed explicitly bridges at 0. Thank you.
Joel Levy, ICI. In the interest of time, I'll just say that we agree with the pronouncement as written here. Although I will say, while folks were speaking, my only thought was in terms of the 80%, this is me thinking while the comments were sort of being said, is that while 80% is that the right number, I think a valid point is brought up. Well, if that last 20% represents 10 more years, maybe that's not valid. Maybe there should be a bifurcation of what that means in that last 20%. So maybe 75% is appropriate if it's only 5 years, and maybe 90% is appropriate if that represents a longer period of time. That's just sort of me thinking out loud, hearing what I'm saying right here, but otherwise what's written here is fine. Thank you.
Rob Hamilton, NASDAQ. We do not agree with the proposed the proposals in paragraph 11 relating to disclosing by network of infrastructure assets the historical cost, accumulated depreciation, and historical cost weighted average age of infrastructure assets that have exceeded 80% of their estimated useful lives. In short, the 80% threshold just amount determination of that just is not clear to us. There's more favor for additional disclosures for those items that are exceeding or are at 100% of their useful life. Additionally, there's some concern that the work that's involved in tracking between the two thresholds will be difficult with repairs and maintenance as it's completed in stages based on need, available funding, et cetera. And for entities with large populations of infrastructure assets, we believe that the additional calculations and disclosures for multiple thresholds will require extra time and resources, questioning whether it meets the essentiality requirements of Concept Statement 7. Further, there were a number of states that just I question just the usefulness of the metric and the cost and the workload that's involved and really trying to get into this threshold. It goes along with some of my earlier comments with some of the feedback that states don't always track their infrastructure assets at this level. And so being able to do so would requiring them to do so, would require a lot of additional work, a lot of administrative burden, and be able to do that. Finally, if this were to move forward, one of the recommendations is to be able to present the information in a tabular format. Some of the narrative gets a little bit difficult to follow, to communicate in a clear manner for our readers. So a tabular format we thought would be a better way to present it.
Thank you. So American Accounting Association, Linda Ragland, our committee group had 3 comments related to this particular question, mainly related to relevance and cost benefit. So in our minds, while the 80% threshold may be viewed by some as a proxy for deferred maintenance, are there other proxies such as the average remaining life that governments are encouraged to consider including in this disclosure that may provide more relevant, meaningful information to the user groups? Additionally, we had several questions about, if possible, could the board provide more guidance on, well, what happens if an infrastructure asset falls out of that category? It moves back above the 80% threshold. So what is the guidance in terms of removing these assets from that disclosure? What systems and controls are recommended to be put into place to ensure that that reclassification is consistent and accurate over time? Moreover, with the addition of significant improvements, could these assets fall back under the reporting threshold? Again, what guidance is recommended to ensure judgment is applied consistently? And to piggyback on Rob's comment, we kept coming back to the cost benefit piece. This is going to be very costly. So we have questions about the value added of providing this information. As we know, administrations where you have burdens in the municipal space. So those were our 3 comments related to that question. Thank you.
David Goldman, National League of Cities. We agree with Harriet and some of the other comments around here. Harriet specifically said to use a condition-based disclosure along with other criteria. We think that establishing a rigid 80% threshold is a risk, and it might cause unnecessary public concern. An infrastructure asset like a bridge with a 50-year estimated life might reach 41 years, 82%, and still be perfectly safe and structurally sound based on ongoing maintenance. If we're forced to highlight millions of dollars of assets exceeding 80% of useful life in our notes, the local media or bond analysts may misinterpret this as a looming infrastructure failure. And the last thing our governments want to do is unnecessarily mislead our bond analyst friends by the implementation of a rigid rule. Also, you're requiring already constrained staff to calculate a complex historical cost-weighted average age for these specific assets introduces a new math regime, which I love, but non-accountants might be a little baffled by it, and it would add hours to our year-end closing process. So.
Frank Crawford, number 12, hoping to get to number 11 after this one. As far as network reporting is concerned, I think there's some transition guidance that we would like to see. So we would recommend the inclusion of practical expedients similar to those provided in Statement 34 for the restatement of infrastructure information in the capital asset note disclosure. Governments should be permitted to use reasonable estimates supported by engineering records, inventory information, replacement cycle data, or other available evidence, including even a deflation of current costs, accompanied by a disclosure of that estimation methodology. The use of estimates would be particularly helpful for those governments that employed the composite depreciation approach for dissimilar assets as provided by in paragraph 163 of Statement 34, and for those previously noted governments that have a capitalized infrastructure additions as a whole without really retaining any network documentation. Many governments complied with 34 exactly as it was understood at the time. So now requiring them to recreate that information that was never really required to be separately maintained risks rewarding record retention practices that, in hindsight, probably few governments knew they really needed at the time. As far as the 80% rule, we support the concept because I think it provides users with a straightforward indication of aging infrastructure. However, as the board is well aware, age and condition are not the same thing. Anyone who has attended a city council meeting knows that a 60-year-old water line may still be performing admirably, while a 5-year-old street may already be generating complaint calls. So age can be a useful indicator, but it should not be mistaken for a direct measure of condition. As the GASB then prepares user materials to go forward with this statement, including the video series that you have for elected officials, I would recommend that that important difference be highlighted in that series.
Stephen Stewart, Governmental Research Association. The network-based disclosure for 80% depreciated can give public and elected officials a clearer big picture indicator of infrastructure asset life. So we support that. However, the sample disclosure that's on page 26 of the exposure draft is difficult to digest and disconnected from the total asset figures. It would be more effective to present the 80% figures in a table format alongside network by network asset totals to give a clearer at a glance picture of where each network stands. But overall, having these figures helps with public oversight of infrastructure.
All right, thank you. Would anyone like to follow up on what they've heard or add to their prior comments? And Robert.
I just real quick, when Franklin mentioned the record retention requirements, that really resonated with me. I know, at least in our state, we have a requirement under rule to destroy records once it gets past a certain date. So some of that information may actually not be available any longer. And that kind of dovetails into some of the comments that some specific states referenced that just to expound on real briefly. One state had indicated that the individual asset histories no longer exist. So getting into some of the record retention requirements, and then getting back to a comment I mentioned earlier about 80,000 miles of road network, getting to that level of information to get this threshold of the 80% would be a very challenging task in order to zero in on the information and perform the calculations.
Scott.
Yeah, Scott Devaney, AGA. Yeah, that's what I want to follow up on, is just this idea that it would be costly. And I think our group was very much recognizing or wanting to convey that the weighted average useful life calculation would be an additional burden and a cost. But we couldn't imagine how just identifying the total amount for by network for like just the 80% or 100% threshold would be costly. It's just the capital asset records and a simple addition or a simple report. So I don't know if there's something I'm missing there.
Oh, I mean, for my city personally, we're good. But there's many cities out there that are smaller and they might not have the same level of records and, information that we have built up over time. So, and that was the feedback I was getting from my group. So,
But David, can I ask this question? And today, all the governments. I understand there may be a conversation around infrastructure as one line and maybe not doing it by network. So I'm going to stay away from that for 1 second. But all governments today report infrastructure, the historical cost of it, the accumulated depreciation of it, and they know what the estimated useful life of it is because that's the only way they can calculate what the depreciation expense is. What's the cost of having to know that? We're not asking you to change. We're not asking you to take your roads and give me that number by each mile of road. If road for you is one thing with one line, and you know that that's what it is, I mean, it feels to me as if folks believe that we're asking them to break this information down at a way lower level than we're asking them to break this information down at. Because theoretically, this 80% disclosure would be at a level of detail you have today. Maybe the network thing is is an additional layer, and I appreciate that. But I struggle with where the cost is, with just knowing which assets are more than 80% appreciated. There's work to calculate the weighted average age, and I appreciate that. But just purely to say, here's the stuff that's 80% appreciated. Where is the work? Don't you have to know that today to be able to do your reports today?
Well, I think they were kind of including the network thing and all the other changes too, along with these calculations. So, I mean, that alone, makes sense. It won't be that backbreaking level of work to get to there. But it's just, they were kind of looking at this in total, with all the other changes too. So.
Bob. In my letter, I fully acknowledge it's easy. It's very easy because I have depreciation layers. So if I use 30-year depreciation, I go back 24 years in 2002 and earlier. That's what I disclose. It's simple. My question, though, and comment was, I'm not sure it's useful. And I also think use of the term estimated useful life implies a target replacement date. And target replacement dates work real well for equipment, for vehicles, not so well for infrastructure because I'm not going to replace a bridge if it's in good condition just because it's reached that target, quote unquote, end of its estimated useful life. And so that was my concern, was that we might be implying in the disclosure by requiring me to say my estimated useful life, this is 80%. I'm saying this is what I should replace in the next however many years. And it's going to be based on condition assessments that Public Works and Engineering does, not based on my depreciation period.
Scott?
Yeah, Scott with the AGA. I think my response to that would be, then shouldn't you change your estimated useful life based on a periodic review? Because I think ultimately the words estimated useful life and the concepts behind it should align with like when the asset does need to be replaced. I mean, there's remaining questions about maybe you're not going to replace it, or maybe you're going to replace it in a different way. But I think that the value that we're trying to provide to users is what is the sense of capital projects that are on the horizon. And I think the other thing is that if there has been deferred maintenance that does impact those financial decisions, then it needs to get incorporated like, oh no, now I actually need to impair my assets, or the estimated useful life is suddenly shortened because I haven't been doing the maintenance that I needed to do. And if governments do assess that and reflect it in their figures, then we get useful information. If they don't do that assessment and don't reflect it in their figures, then I think we get what we have right now.
All right. Then before we move, I was going to say, before we move on and turn it over, does the board have any items they wish to follow up on?
I guess I'm ahead of you, Joe, by a second sentence. I just wanted to quickly mention, because I heard several times this confusion about the usefulness of the information, particularly weighted average age. And I just wanted to mention, for example, there was a fairly major research study done by some municipal bond analysts about this very topic, what is the replacement cost burden that governments are sitting on top of? And it got a lot of major media play. It got into major media outlets because the top line number they came to for the cities they looked at was large. Now, they did it based on very rough numbers that are available now in financial statements. Some of this information to me in paragraph 11 is going to help them become a lot more accurate, because right now they're just taking that one line item of infrastructure, taking that one number and saying everything that's accumulated depreciation, you need to replace. Now, that could be the first 5% of depreciation, right? But because they don't have any other way to do it, they're looking at it, and now this happens to be a data aggregator. They're selling this metric to municipal bond analysts because municipal bond analysts are looking for information about how do I assess what this impending replacement cost burden is going to be. And interestingly, one of the things they did in there is they figured out replacement costs by using inflation adjusting the asset. And what the board is trying to do here through weighted average age is to provide that information so that, guess what? A user could inflation adjust the asset so that, yeah, the original historical cost is old, but I now know how old it is. I can make some assumptions about inflation adjusting and figure out what that potential replacement cost would be. And so that's just to sort of see, like, and it's happening now, right? Without us doing it, they're doing it on the best information they have. It's not very accurate in my view, right? But the need is there, and they're trying to develop it precisely along the lines here. So just to help out, how this information might be used.
So, I mean, I guess what I'm hearing is there's a dilemma. There's like millions upon millions of infrastructure assets throughout the United States, and every one can be considered almost unique in a way, but it's impossible to really get down to that granular level of detail throughout the whole country to figure out, like, this asset has, I mean, although we originally said it's a 30-year asset, it actually has 35 years. And then this asset, it only has 25 years, even though we said 30. It's difficult to really ascertain that. So what the bond rating agencies need and what the analysts need is just some way to simplify that in order to look at something and go, okay, this is the risk we think that this particular agency or governmental entity has, so that we can properly, or not, as best as we can, come up with a risk analysis so we can provide, a rating and give that out to the market. Yeah, I mean, nothing's going to be perfect. I guess with AI, maybe we'll get there. I was talking to Joel about that, but with technological advances, we can definitely get to more granular detail over time. But I still kind of think that having an 80% rule, I mean, my accountants love it. Like 80% good, we're good. We know exactly what to do. It's simple, but you do get the point where, some assets actually are going to last 50 years instead of 30 years. So we need to kind of condition those, maybe take those out and put them in a different category, or something. I don't know. There's got to be a way to do it where it's not a free for all, where everything is just what you think it might be, but also it can't really just be a hard and fast rule where 80% and that's it,
Yeah, but I think that's the interplay between paragraph 11 and paragraph 7, right? Where you're updating your periodic estimated useful lives, right? And so now, in a way, this may provide some incentive to update it in a way that if they really are 50-year assets, not a 30-year asset, update your estimated useful life to make it that way, right? Because what I would believe as an analyst, if it gets to this 80 or 100%, it really is 80 to 100%. We're really at the end of their estimated useful lives. And then now I have to start asking questions about replacement cost, like what's going to be their debt burden to replace all of these assets that are pretty near to needing to be replaced.
Chris?
Just two things real quick. One, I know we're focusing a lot on rating agencies, and that's fair as users, but let's not underestimate or underappreciate the importance of this information for administrators, right? Government administrators. Foundationally, the rating agencies are looking at this information because they're saying, and they want this information saying, this is the information that the government should have and be using to make decisions in running the government. And so there's something fatally flawed if we're saying that the government can't get to this information or can't contextualize the information in the right way, because then that means that the government can't make the right decisions, which fundamentally is what we want to ascertain through like this whole project, right? Like, how are you managing from a cost perspective, from an investment perspective, these capital investments going forward and the related maintenance? So if we can't do that, then we have a problem that's way bigger than serving the needs of the rating agency community. And then secondly, I would just say along those lines, in the same way that we take in information on the government side and digest that information and contextualize it, and we're able to articulate and communicate, no, this 80% means this, or whatever it means. That's the same energy and the same communication that'll be necessary going forward, right? So that it's not viewed in some kind of vacuum and someone might make an incorrect assumption. And so whether in MD&A or whatever it is, in the context of your ACFR or the conversations that are supporting the ACFR as part of, going to the market or whatever, you are explaining what this means in the context of your organization. And that's important. And that's something that we should be doing regardless.
All right. Before we move on, Alan, did you have?
I have this thought running in my mind, and I don't really know how to articulate it perfectly clearly, but some of what I hear, I think some of what's happened is almost like there's a contradiction going on. We have all these infrastructure assets we're recording at a historical cost depreciation basis, but we really maintain them on a preservation basis. And really the way we really should probably be recording these things is on a modified approach. And the board thought about that and talked about that, but said if we say everybody's got to do all your infrastructure assets on a modified approach, because really you think they're really never going to get to the end of a useful life because you're going to keep them forever, right? And it's really about condition. Well, then we should do in the modified approach. But if we said that, I think the loudness we would hear about the cost of that would be through the roof. It'd be like, all of a sudden that's too costly, we can't do that. So then the board says, okay, so we'll stay with the historical cost depreciation method, but then don't make us make our useful lives be right. Well, so it's like it's like we almost have to have one of those be true. Either we're preserving them, so the modified approach is right, and that's how we account for them, or we are going to depreciate them, and therefore we need the useful life to be right. Because I can tell you that a lot of the users we talk to, that useful life number or that number and that depreciation expense is central to how they look at these assets, because they believe it really will get to an end of useful life. And I guess I'd say if it doesn't, or we're suggesting it doesn't, then maybe we should be picking the modified approach and not picking the historical cost method. Just because I think that's out there, and we're kind of like almost suggesting in a way that that's how we treat the assets, but that's not how we account for them. And that's a little bit maybe worrisome a little bit. Joel.
I just want to echo some of the points that are made here about, or some of the concerns that each individual asset is a discrete asset. And I would just say, obviously it is. That being said, the materiality side, I don't want to lose that. The city of Charlotte that's where I live, so that's who I'm just going to pick on. But they have 44 fire stations. And while yes, each of those fire stations is a discrete asset, I don't, from a materiality perspective, each one of them individually is not material to the city. So to the extent from an investment perspective, if you told me you had to replace fire station 7, that's not going to necessarily change my group's investment thesis onto whether or not they should be investing there. So if the discrete asset side of it became too onerous for some municipalities, I would just say that aggregating the 44 fire stations as one fire station line, just as an example, and that as a percentage reported would provide value as well. So I think just on behalf of ICI, we do recognize that different municipalities have different abilities and needs, and we don't want to ignore that. But that being said, it is something that actual investment decisions are made upon.
In that example, your 44 discrete fire station assets, is it one asset, the fire station number 44, that's the asset? Or did you componentize the roof of the fire station, the walls of the fire station, the garage doors of the fire station? How do you have it in your records now?
So, well, I don't work for the city
No, I
anymore.
get it.
But
What do you think?
But this gets back down to the materiality side of it. The roof of Station 7 is not material to the city itself. If all the roofs of all the fire stations had to be replaced, that may be. And so that's a separate conversation. But for me, I just always come back from the investment thesis standpoint. There's data that's nice to have, of course, as we all know, and then there's actionable data. And I'm trying to, in my mind, tease out from an investment perspective, was the actionable data. And there are certain assets that are so large that obviously they should be treated within their own system, especially in a smaller municipality. But that tends to change the larger the municipality and the less material is to the overall balance sheet.
So if you consider, let me make sure I understand this. If you consider the fire stations themselves as a network, all 44 of them together, you're telling me that componentization of those does you no good?
No, I mean, I think componentization of the 44 of the roofs of the 44, if it's not material, doesn't change in the investment thesis. But the 44 fire stations themselves will be material.
I think part of this, Frank, is a little bit of us trying not to get in unit of account. Because in your example, I suspect that the 80% threshold will be applied. Let's assume the government has all 44 fire stations as individual assets. That's what I'm trying to let's assume it's 44 individual fire stations.
Right.
The 80% rule would apply to each one of the fire stations. So that one fire station that's over 80% depreciated would end up in the disclosure.
Correct.
The other 43 that wouldn't. But if a town had individually just componentized the roofs and the side, that's their unit of account. That's a slightly different answer, and so that does kind of play into this a little bit. So it is a little bit of how they are treating their unit of account today.
Yep.
But I do think in that scenario, I use a slightly different scenario, and why the fire station is relevant is, 44 fire stations is a lot of fire stations. What if it's 2 water treatment plants? And the one water treatment plant is 60 years old, but it's a 40-year life, and the other water treatment plant is 10 years old with a 40-year life. Right now, today, you'd see those two numbers put together. And I think, Joel, you would say in that case, you want to know about the one.
And that's where I was trying to go with being more material versus just the fire station.
So I'll circle back on that. Materiality box will be in the standard very likely, right? So you can get to doing what's material and doing when it's material.
And so in that situation, his 44 fire stations as one network would not be the same as 2 water treatment plants, which would be 2 different networks.
I would argue those are both singular networks. The water treatment plant's a network. Well, one could argue, the board's going to make decisions. One could argue that the water treatment plant is a network and the firehouses are a network. But buildings, see, we're getting a little tricky, right? Because firehouses are really probably not in infrastructure.
Right.
So we got to be careful with using firehouses because they're probably.
But in his situation,
I don't want anybody's room to think firehouses are now
in that situation of the 2 wastewater treatment plants, if you combine them together, you're not going to get the information of the one that you want. So you would have to treat them individually, unlike the grouping of the 44 fire stations, which again, bad example, but.
And I think this is right to close it down. I think you have a water treatment network, but in terms of the 8% disclosure, you're disclosing that water treatment plant, which is part of that network. That's how I believe it would work.
All right. Want to make sure with the time we have left, because we've got about 23 minutes. The next question we're going to move forward to, just because we're going a little bit out of order. So folks that have the notes, we're going to be talking about maintenance and preservation expense, which is question 8 in your materials. So again, the basis for conclusions of the exposure draft includes the board member's alternative view that the proposal should include information about amounts governments intend to and actually expend on their infrastructure assets to allow them to provide service to their estimated useful lives. Though the preliminary views proposed to provide such information, as no disclosures in RSI, The board was persuaded by feedback from respondents to the preliminary views that the costs expected to be incurred by governments to separately track maintenance and preservation expenses related to infrastructure assets do not justify the perceived benefits users of financial statements would receive in comparing those expenses to their expectations. As such, the board did not carry forward those proposals in the preliminary views to the exposure draft. And that is question 8, which is, what feedback do you have about the board's decision to not require governments to disclose maintenance and preservation expense in those financial statements as proposed in the preliminary views? And Stephen, if you wouldn't mind starting us off, and then we'll go counterclockwise.
Stephen Stewart, Governmental Research Association. So the GRA, who I represent, we're a group of organizations that provides nonpartisan research for better state and local government. So the decision not to require disclosure of maintenance and preservation expenses, is a missed opportunity to strengthen accountability for critical infrastructure assets. Unless users have special insights into the budget line items that make up maintenance expenses, it is very difficult for us to track them accurately. And we think governments should help their constituents to see the level of effort that they're making on asset maintenance and preservation, which directly affects their quality of life. All that said, it is not hard to see the concern about the potential reporting burden. The concept of maintenance is very broad and very different for each type of infrastructure network and even components within those networks. Some maintenance costs are also expensed while others are capitalized. In reviewing some of this from my time on GASAC, I did have the lingering question about whether a fuller exploration of the definition of maintenance and what might fall within maintenance and preservation might be beneficial for GASB to consider. I don't know if adding clarity with the definition would help to resolve some of the gap between users and preparers on this point. But I guess this kind of depends on where the board is in terms of its position on, not moving forward with, anything further on maintenance. But we would encourage GASB to consider, researching that further to possibly bring clarity to the topic.
Frank Crawford again. I purposely did not comment on the alternative view in my letter because I was a little bit torn. While I have sympathy for the views in paragraphs B52 through B60, I just could not get to a situation in perspective with especially my medium to smaller size governments of the ability for them to separately track maintenance and preservation expenses related to infrastructure and how costly and difficult that might be for those smaller governments. And so, again, I sympathize and probably kind of agree with the alternative view, but I don't have a way forward that I think the cost would justify the benefit.
David Goldman, National League of Cities. In the interest of time, if I say something stupid again, please ignore me like my family does. So we strongly applaud the board for dropping this requirement. As the field test participants correctly noted, not all local governments currently track maintenance and preservation as separate accounting categories distinct from other operating expenses. So.
Linda Ragland, American County Association. So our committee group was also torn. So that is not in our comment letter. The only notes I had is hopeful. If you're putting a lot of time, energy, and money into preserving your assets, we hope that you'll signal that in your MD&A. So again, our group was torn as well. So that is not in our feedback.
Rob Hamilton, NASDAQ. This is not in our comment letter. We didn't have a strong position either way, but those that did provide feedback, they were in support of removing it from the preliminary views. One state expressed concern that it could, including it could be misleading to users.
Joel Levy, ICI. I think we would have preferred that the maintenance and preservation expenses were in there and let users decide if it's providing information that they want and have subsequent follow-up conversations about what they're seeing. That's all. Thanks.
Scott Deviney, AGA. We strongly agreed with the board's decision not to require disclosure of maintenance expense. A couple of factors there. I think there's a lot of logical reasons why this information doesn't exist and it'd be burdensome. And then the evidence is a field test. I think our group continues to be skeptical about whether reliable conclusions can be drawn from it. Since it can be, the amount budgeted or spent on maintenance expense can be affected by a multitude of positive or negative factors. I think our group just views estimated useful life as the superior and more decision useful information, so long as it's accurate. Which brings me to the last point is if governments aren't componentizing right now and they don't have those policies in place, then I don't know if classifications for maintenance expense are reliable or consistent enough at this point. So I think it's very sympathetic to the idea, like other commenters. I just don't feel like we got the foundation for it right now. And I'd encourage the board to just take this really big issue one step at a time. Governments need to have a policy that defines what's embodied in their estimated useful life, meaning what's their components and what's maintenance expense. We need a lot of implementation guidance. We need a capital asset project on this. And then I think there'll be enough time where you'll have a better sense of whether to do this in the future. Thank you.
Bob Scott, I'm like Frank, I'm torn. I see the value of it, but I also know that expecting my public works folks to properly classify work orders into maintenance, and I also know that quite realistically, the best thing I can track are contracts because I know what the contracts are for. But the work done in public works and expecting them to code it to the right areas so that I can accurately accumulate that information, and knowing too that we have a work order system. Not all governments have a work order system that would allow them to accumulate that information. So I'm sympathetic to it, but I just can't see that we can get there very easily with many, many governments.
Harriet Richardson, Association of Local Government Auditors. So ALGA thought that deferred maintenance information should be better addressed, that it not disclosed and appears to retreat from providing users with direct maintenance or need or deferred maintenance information beyond age-based proxies, and that those do not tell the full story about whether infrastructure is being maintained adequately, and recommends putting some sort of practical indicator in that better communicates deferred maintenance risk without imposing some sort of excessive burden. They also looked at the alternative view and recognized that the alternative view highlighted challenges in implementing some of this, particularly for smaller governments that may be unable to compare the cost of a replacement project to the original cost, given how the records were maintained, and that GASB should address these concerns by explaining how governments may use reasonable estimates, allocated costs, or practical expedients when historic costs are incomplete. Thank you.
Thank you. Would anyone like to follow up on what they've heard or add to their prior comments? And barring that, do any of the board members wish to follow up on what they've just heard? Jeff.
See, Alan was expecting that, but some people might be able to guess who the alternative view was here. But I just wanted to explore one other thing that I thought was interesting, Bob, in your letter, where Because in theory, right, and I've heard it expressed, like if you do your periodic evaluations right, this thing could be mitigated. And part of me agrees with that. And I think it was in your letter, you said maybe that periodic review ought to encompass some form of acknowledgement that if you believe you've had deferred maintenance or some notion of deferred maintenance, you ought to be periodically reviewing your estimated useful life. Because I think a lot of our conversation is the useful life estimates will go in one direction, longer. And the concern here is that the estimated useful life is going in the other direction, shorter, because you're not maintaining it well enough. And if it's not, and I understand the burden of maintenance expense, I hear it, but I struggle with the need for somebody saying it's 30 and they're not maintaining it so that it might get to its 30. And do you think, so I just wanted you to expand on that. Do you think that that would be doable, and would it get governments to sort of, would governments acknowledge and say, hey, I'm not maintaining this thing for 30 years, it's going to only be 25 now, and I got to actually shorten my estimated useful life?
I think some would. I think GASB needs to set criteria for what that re-estimate and some of the considerations governments need to think about as part of the re-estimate. Let's use our example of asphalt roads. If we know to get to the useful life of the asphalt road, we have to do mill and overlay every 8 years. And as a budget decision, we delayed that to every 10 years or every 12 years. Yes, I think if asphalt roads as a whole are material that the government needs to think, there's going to be a lot more water leaking in to the base. It's not going to last as long. Maybe I need to shorten the useful life. So no, I personally think that's an appropriate measure, and quite honestly needs to be part of the budget discussion. Well, yeah, we can defer maintenance. Deferring some maintenance doesn't really cost the government anything. Deferring maintenance that causes the road not to last as long, like crack sealing for concrete roads or mill and overlay for asphalt roads, can reduce the useful life.
All right. I'll say with the limited time we have left, want to make sure we touch briefly on the feedback provided for, this would be for question number 5. So I'll pose it relatively quickly. Just reminder that paragraph 9 of the exposure draft proposes that information about infrastructure assets should be included with no disclosures about capital assets and divided by network. And so you all have the background material. I'll save us from the rest of it, but I want to put question 5 out there for the group to respond to, which is, what feedback do you have about the proposal to divide information about infrastructure assets by network within note disclosures about capital assets? And Scott, if you want to lead us off, we'll go clockwise.
Scott Davini, AGA. Sure, makes sense.
So Olivia, ICI, I agree. We should do it.
Rob Hamilton, NASDAQ. For our group, we're just looking for examples to make sure it's being implemented the way it's intended. So
My group did not have a comment on that particular question.
Thumbs up.
Give me some examples. I'm all for it.
Stephen Stewart, Governmental Research Association. We agree with the comments that have been said.
Harriet Richardson, Association of Local Government Auditors. I'm going to be a little bit different here. Alga thought the network disclosure might be too rigid in some cases, because for some governments, the most meaningful level of management and monitoring might be the subsystem, and that there should be some flexibility in allowing one or the other.
Bob Scott. No, again, with some examples and more clarification, I'm fine with that.
So that somewhat keeps us full circle, right? Because at the end of the very first conversation we had about the definitions, we talked about the definition and examples. Then we come back to this about disclosing by network and its examples. We will work on that clearly. The staff will work on examples and we will take that away and try to deal with that. But if you have them and you know what you think the examples are and you know what you think would be good examples, that will just help speed our ability to actually try to understand what those are as well.
And I'd say before we move off this topic, would pose a question to the group. Does anyone have any follow-up after what they just heard or their prior comments? Seems like everyone had a pretty distinct view on the same page. And before we close out on question 5, do any of the board members wish to follow up on what they've heard about dividing note disclosures by network? Okay. Well, and I think we're probably at our time.
I did one last comment I didn't cover, but I would just like for everybody to consider, although, again, I've been supportive of the retroactive treatment of the network disclosures and the prospective treatment of the componentization for the newly placed in service assets. However, given the effort that many governments that have not previously reported, or at least not separately depreciated, different networks will face, I would recommend that you consider changing the effective date to a reporting period beginning after June 15th of 2027. I think that would allow governments more sufficient time to gather information necessary to make reliable estimates. And I didn't hear anybody else say anything about transition and effective date, so I figured I would just throw that out there.
So I guess, and that was going to kind of be closing out, in time remaining, what other comments would any of the participants like to share with the board about the proposals, if any? And then turn it back over to Joel. Harriet.
Yeah. Just one quick one on question 7 that we didn't cover. Alga felt that having requiring governments with a policy to be disclosed was not complete because it leaves some sort of a gap in showing what the governance decisions are, that governments that do not have a policy should be required to disclose that they don't have a policy.
Scott.
I guess I would say if you don't have a policy, you have a policy, right? I mean, whatever, to me, in my comment letter, I said, if they have a longstanding practice of doing something, even though it's not a policy, but you budgeted for it for the last 15 years or 5 years, 10 years, then in essence, you have a policy. And my recommendation was to make it clear that it can be an informal policy. It can be, past practice has been to budget $500,000 a year for crack sealing and X number of dollars for other types of routine maintenance that you would expect taking place on your infrastructure assets. So I would try to do everything possible for governments to disclose information about what they are doing and just call it an informal policy.
Scott.
Yeah, with question 7, we disagree. I think it's just confusing to apply a requirement for modified approach to the historical cost approach. And I thought Alan's comment earlier was the right one. Like, just pick a lane. No pun intended. But the thing I wanted to just double underline is our view that that the board should add a requirement for the government to have a policy defining the components by network. Again, doesn't need to be disclosed. They just, for operability and auditability, they got to write that down. And I think that's just a really critical factor to governments defining, what is embodied in their estimated useful life. What are the components that they have by network? What is considered maintenance or not maintenance, et cetera. That's super critical, in the same way that it's critical to, if we're not going to define it by standard, then, require a policy for periodic review. Thanks.
I think last one we have,
And I'll be quick. Rob Hamilton, NASAC, this is not in our comment letter, but there were states that were similarly supportive of what Harriet added around requiring a disclosure when no policy exists, consistent with GASB 40, paragraph 6 on some of the investment and deposit policies. And then there was confusion also whether this paragraph applied to all infrastructure assets, whether or not you're taking the modified approach or the historical cost. Just from an interpretation standpoint, some were confused as to whether it did apply to those that have historical cost assets.
All right. We really appreciate this. Was a great discussion, very valuable. Got a lot of expansion upon your comment letters, got information from some of you that we don't have comment letters yet from, and then good discussion back and forth and dialogue. I think it's been very helpful for the board as we continue to move forward. We do still have 2 more scheduled public forums. Both of those will be virtual. So if anybody is interested in participating that is observing this one, love to have you sign up and join in those later in July. And with that, we will consider the public forum adjourned. Thanks, everybody.